What's up guys, welcome back to the new video. I'm your host Yash from Equity Master, trying to make markets simpler for you. Thank you for tuning in every week. It means a lot. Before we move on, please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There's no opinion or view on any stock covered herein. With that disclaimer out of the way, let's get started. In today's video, I'm going to be talking about some high dividend yield penny stocks. Penny stocks, known for their low price and high growth potential, often attract investors looking for significant returns. While many of these stocks carry higher risk, some stand out for offering high dividend yields, providing steady income alongside the possibility of capital appreciation. As we approach 2025, a handful of penny stocks are emerging as attractive options for investors seeking a balance of income and growth. High dividend yield penny stocks are appealing because they offer the chance to earn passive income even if the stock price remains stable or grows slowly. Despite their low prices, some of these companies have strong fundamentals in place and have a proven track record of rewarding shareholders. Without wasting any further time, let's look at 5 such promising high dividend yield penny stocks that are worth monitoring in 2025. The first stock on this list is Andhra Petrochemicals. The company manufactures and sells OXO alcohols. Its products are mainly used by domestic manufacturers of dioctyl phosphate, which is used as a plasticizer to manufacture polyvinyl chloride. At the current market price, the company's dividend yield comes to 2.7. Andhra Petrochemicals has paid consistent dividends over the past few years. The company has been maintaining a healthy dividend payout of 33.5% over the past 3 years. Going forward, Andhra Petrochemicals stands to benefit from the trade protection measures such as the anti-dumping duty imposed on several countries for the import of NBA and 2EH. It's also in a duopoly in the domestic OXO alcohol market, with BPCL being the other player. The company has moderate capex plans in the near term towards value-added products to be funded by internal accruals. Despite its dividend history, the company has delivered poor sales and net profit growth over the last 5 years. Its return on equity and return on capital employed stand at 11.4% and 17% respectively as of March 2024. Moving on, the second stock on this list is NHPC, India's leading hydroelectric generation firm. The company supplies power to utilities across eastern, northern and northeastern regions through long-term power purchase agreements. It boasts a total capacity of 7,000 megawatts, filling the gap during peak demand periods when solar power falls short. NHPC's dividend yield stands at 2.3%. Its 3-year average dividend payout stands at 50.6%. In the past 5 years, the company has reported a poor revenue and net profit growth. It also has low return ratios. Moreover, the expansion plans of NHPC exposes the company to the project execution and funding related risk. This is, however, mitigated largely through the company's favorable capital structure, consistent cash flows and cash flow operations with adequate cash and bank balances, and extensive experience in implementation of various projects in the past. Looking ahead, the company has outlined a massive capex outlay for doubling the installed 7,000 megawatt capacity by financial year 2027. It has guided for a capex of rupees 90 to 100 billion for the next 10 years. The company is also shifting its focus towards the solar energy segment. Out of 10,500 megawatts capacity under the construction, the company has allocated 1,135 megawatts for solar power. It has recently signed a contract to develop additional 2,000 megawatts of solar power capacity in Rajasthan. Apart from that, about 9,090 megawatt solar capacity is under tender and pipeline, including as an intermediary procurer. Here's how the company's stock price has moved in the past 5 years. Moving on, the third stock on this list is Tamil Nadu Petro Products. The company manufactures and sells petrochemical products. It was established as a joint venture between SPIC and Tamil Nadu Industrial Development Corporation. Tamil Nadu Petro Products has been in the operations for more than 3 decades and has 3 major divisions, namely lineal alkyl benzene, heavy chemical division and propylene oxide. It's one of the leading manufacturers, about 15% of domestic capacity of LAB in the domestic market, and only manufacturer in South India. The company has established strong relationships with reputed players in the FMCG industry for its products. The company's dividend yield is 1.5%. It has been paying and maintaining a healthy dividend payout of 17.1% over the last 3 years. Manali Petrochemicals is a major customer of Tamil Nadu Petroproducts for its products such as propylene oxide, chlorine, among other things. And at times, Tamil Nadu also purchases materials from Manali Petrochemicals. Tamil Nadu Petroproducts and Manali Petrochemicals are not related parties. Tamil Nadu Petroproducts has reported poor sales growth over the last 5 years while its profits have stayed flat. During the pandemic, the use of one of its products, LABSA, skyrocketed abnormally, leading to a significant increase in lab prices as well. This surge in price has a direct impact on the costs incurred by FMCG companies. As a result, users began to look for alternatives and sodium lauryl ether surface was discovered to be less expensive than lab, and replacement occurred faster due to its ease of use in liquid detergent, which is the most common form in the international market. This impacted the company's sales. However, SLES is only expected to partially replace the LABSA, considering the drawbacks of SLES in terms of product performance in heavy-duty detergent applications and compatibility issues with other ingredients in formulations. Going forward, the company has proposed to increase its capacity on account of an increase in demand from 1,20,000 million tons per annum to 1,45,000 million tons per annum at an estimated cost of around Rs 2.4 billion. In the HCD division, Tamil Nadu Petroproducts has proposed to replace the current monopolar membrane technology for manufacturing of caustic soda with bipolar membrane technology with a new 250 TPD cell house with an electrolyzer. Note that the company has a low promoter holding of 34%. Here's how the company's stock price has performed in the past 5 years. Moving on, the fourth stock on this list is Sathya Industries. The company is one of the leading wood and agro-based paper manufacturers in India with a fully integrated manufacturing setup. It supplies paper directly to various state boards, accounting for almost 40% of its business. It enjoys a 10 to 12% market share with state orders. The state orders are largely tender-driven, funded by government, and generate higher margins in comparison to paper sold in the open markets. Sathya Industries has a current dividend yield of over 1%. The company has paid dividends consistently since 2017. In recent years, the company's business has expanded significantly. Its revenue has grown at a compounded annual growth rate of 18% over the last 5 years, led by the ramp-up of new capacities, while its net profit has grown at a CAGR of 19%. The expansion in financial year 22, accompanied by the increase in its pulp capacity, has aided to the sentiment. It has also improved the company's product profile by increasing the proportion of high-quality wood-based paper to 28% in financial year 2024 from 25% in financial year 23. The new capacity has also enabled Sathya Industries to manufacture a higher quality copier paper in addition to catering to incremental demand from state education boards. Looking ahead, Sathya Industries plans to modernize its existing plants and machinery to improve efficiency and product quality. The company is also considering setting up a new paper machine within its existing premises, which could potentially double its production capacity. Moving on, the last stock on this list is Manali Petrochemicals. The company manufactures propylene oxide, propylene glycol, and polyols, which are used as industrial raw materials. It is the only domestic manufacturer of propylene glycol. It is also the first and largest Indian manufacturer of propylene oxide, which is the input material for the aforesaid derivative products. Manali Petrochemicals has a dividend yield of 1.2%. The company has been paying dividends since the year 2006. The company has delivered a poor sales growth of 5% over the past 5 years, while its net profit has fallen by 18% on a CAGR basis. The recent performance underscores the ongoing macroeconomic pressures faced by the company, especially as it grapples with rising raw material costs and competition from cheaper imports. This challenging environment has put the company in a difficult position, particularly given its inability to pass on rising input costs to customers. These factors have collectively affected its profit margins, reflecting the need for strategic adjustments. Looking ahead, Manali Petrochemicals is adopting a balanced approach. The company plans to prioritize cost efficiencies to better manage operational expenses, which could help stabilize margins in the current competitive landscape. Despite the domestic challenges, the strong contribution from its overseas subsidiaries have been a bright spot. These subsidiaries support the bottom line and demonstrate the potential of its diversified business structure. These subsidiaries could play an increasingly important role going forward in driving the long-term performance, providing a crucial counterbalance to domestic market pressures. In terms of expansion, reportedly, Manali Petrochemicals is progressing with plans to broaden its product portfolio and increase production capacity. With both greenfield and brownfield projects in the pipeline, such as the propylene glycol and polyester polyol plants, Manali Petrochemicals aims to strengthen its balance sheet and strengthen its presence in high-demand sectors like pharma and consumer goods. Here's how the company's stock price has moved in the past 5 years. So there you go. These were the 5 high dividend yield penny stocks for your 2025 watch list. Investing in high dividend yield penny stocks can be a strategic way to generate steady income while benefiting from the potential for capital appreciation. These 5 stocks highlighted above demonstrate promising qualities such as reliable cash flow and strong dividend payout histories, making them noteworthy candidates for 2025. However, it's important to remember that penny stocks often come with greater risk due to their lower liquidity and higher volatility. Thorough research, careful analysis, and an understanding of the underlying business models are crucial before committing your capital. As 2025 unfolds, keeping an eye on these high dividend yield stocks could offer opportunities for income and growth. By balancing risk and reward, these stocks may serve as valuable additions to your investment strategy. Always consult a financial advisor if you're unsure about making investments in this space. That's it for today, guys. Don't forget to like this video and share it with like-minded investors and make them smart as you are. For more details on this story, check out Ayesha Shetty's article with the link provided in the description below. Happy investing!